Hi, welcome to Carnegie and our interview with Elanders. My name is Mark Sandberg. I'm an analyst here at the bank. I have with me Magnus Nilsson and Andreas Wikner, CFO and CEO at Elanders. Hi, gentlemen.
Hi, Marcus. Hi, Marcus.
So you just released Q4. If we start with top line, minus 11% organic growth. Maybe we start out by you can give us some color on the markets and demand, and also what was price mix out of the 11?
I think if we look at the negative growth of 11%, then actually around 6% of that is connected to the normalization of pricing of Air and Sea. So underlying was for us 5%. And what was it more you want to know?
No, just maybe some general color on the market and demand and what you're seeing.
Yeah. No, but I think overall, all our customer segments continues to be soft in Q4. So I think, for lots of them, their demand is down with around 5%, which our organic growth went down with as well. So it's, I think automotive was the most stable one, but they have been pretty more soft for more than 1 year. But rest of the areas, electronics a bit worse, industrial bits more solid, and fashion is down around 5%.
And looking at the markets, I think both Europe and US, it has been the same signals, I think, for both our big markets. Asia has been a little bit softer than the other two.
Mm-hmm. We'll dig into all of these one by one, in the interview, but maybe starting out with the price correction, the 6% price that you've seen. When did that kick in? That is, when will the year-on-year effect normalize?
I think that will start to normalize, if you mean the Air and Sea price effect, that will start normalized in Q1. Because that was the prices was very high in 2022, and then in 23 Q1 it started to normalize. So that effect will disappear during Q1.
Okay. And if we dig into different areas, and maybe starting with supply chains, since it's the biggest area, minus 13% organic growth. And if we start with electronics, it's been weak for a while, but what has the sequential development been, and how do you view it going into 2024?
I think electronics has been weak since already in the end of 2022. So I think the levels in Q4 was roughly the same as the rest of the year. It's been a bit up and down. I think if you look at laptops and printers, very weak in October, more stable in November, December. But then for some other electronics customers was even weaker in November, December than October. So overall, I think electronics is really hard to predict, but it's a very soft year in general. But I think for us, important was that laptops and printers have stabilized in November, December. So we hope that trend will continue. And then, let's see how the other customers are developing. But that's Europe then, yeah.
Mm-hmm.
In Asia, it's still very weak because Asia we work more with for the manufacturing logistics for electronics companies, and the volumes are still on a much lower level than before.
But again, there's no sequential deterioration. We more see stable, but at a low level.
Yeah.
Also in Asia.
Mm.
And the laptops and the printers, which you said stabilized in November, December, there's a stabilization rather than an uptick we're talking about.
No, it was a slight uptick compared to September and October. So that was a positive signal.
Mm-hmm.
Then we need to see how to follow if it continues. But some of our customer things there should be a so-called backlog in the market because companies have been waiting to do replacements and maybe also consumers. So they're hoping it will pick up a bit during 2024.
And if we move on to fashion, so fashion continues to be weak, and we talked about this quite a bit over the past couple of quarters. New customers that were supposed to compensate for customers that were being lost in the second quarter. and that hasn't really happened. Has this been in line with expectations? The inflow of new customers.
I think we just make a difference, because in Europe we are working more with bigger clients, and in North America smaller and medium-sized clients. And there we had hoped that the inflow of new customers should compensate for the decline in existing, and also that we lost some customers that went bankrupt. But that went slower than expected because the market was softer than expected, especially in Q4. So that's hard to predict, but we think that, hopefully we will now, it will stabilize and we can continue add customers like we do to compensate. If we look at Europe, where we have really big customers, we gained 2 very important customers in 2023, and their implementation will be in Q1 and Q2 in 2024. So we expect that they will help us at least the second half of the year, because it's much bigger clients. But in general, I think our fashion customers is down around, with 5%. So as we mentioned before, for us is that we have an overcapacity problem that puts pressure on our margins. So I must say fashion, it's not so dark for us. It was just that with the huge growth in 2022, we were building up muscles to handle continued growth in 2023 that turned out to be a decline instead.
And again, you talked a little bit about Europe, these 2 big customers, and the US and America. Do you have high expectations for going into 2024 that you will see this compensation? Is it picking up?
It's still a bit uncertain, because in US, because it's of course about the buying power from the consumers. So and everyone is very uncertain about the US for the moment. Did people spend the last of their money in Q4, and will they now be very careful going forward? We think it will have a lot to do what happened with the interest rate. If they start lowering that, we think that the consumers will start to consume more, and that of course affects our fashion customers. Mm-hmm. So what do you say, Andreas? I think
I agree.
Yeah. I agree. So it's very hard to predict for the moment. Yeah.
Q1 might still be soft after the Christmas and
yeah. And on the interest rates and how that affects your sales and your market, I think you said on the call that European customers generally expect the weak H1 and then a recovery in H2. Any end user markets are sticking out from this perspective for you?
No, I don't think so. It's
more of a general
not with the exposure we have, I would say.
Mm-hmm. But I think in general, lots of our customer segments expect a very slow Q1, because they have lots of campaigns, try to sell out as much as possible in Q4. So we expect a slow Q1, and then but then in Q2 that it starts picking up speed again. But that is the signals from our customers as well, almost in all areas, except industrial. Industrial has been more solid all the time, So, but I think if you look at fashion, automotive, electronics, they expect a bit soft Q1, and then that they will see a recovery. But the market is really hard to predict for the moment.
Maybe a couple of words about Kammac. You made this large acquisition during the quarter, and it's one of the largest acquisitions you've made to date. Just a couple of words about what they are and why you chose to acquire them.
No, but we have since we acquired LGI, we have been really strong in Germany especially, and also we have had good growth in Netherlands. But in UK, that is at least I think it's the 3rd biggest logistics market in Europe. We have always been too small to take bigger RFQs from our customers. So we've been looking for a long time to find, a solid platform in UK, like when we acquired Bergen in US to get a solid platform there. So it's around the same story. And then we found this company that has, what we think have developed a rather unique concept, because they have a cluster in Manchester, Liverpool area with 15 warehouses. And with their cluster model, they can handle, huge flexibility. So they take customers both on a short term and long term. And they can maximize the utilization by moving goods between their warehouses. But they also are really smart how to use the employees, because they move the employees around to the warehouses to see, if they have lots of volume in warehouse 1, they send people from warehouse 2 and so on. So they have a very flexible model, and they also have lots of very important licenses, like lots of the warehouses are bonded, which is very important since Brexit, because lots of customers want to take in their goods to UK but don't pay VAT or duty before they sell. They also do export. They have an export license. They have some big customers in beverage where they do export out from UK, and they can handle pharmaceuticals, medical devices, and things like that. So, but the difference with them to, if you say LGI, is they work more wide, have a wider customer base, so they are not so niched in different segments, which have been very beneficial for them. So for us, it will be, we will now be able to go to our existing customers to say, no, we have big capacity in UK, but also the other way around, because lots of Kammac's customers are big international customers. So we also expect that Kammac will be able to grow with the help of the Elanders footprint outside the UK as well. So it's a very exciting and interesting acquisition for us, because now UK will be also a rather big market for us, and we like the UK market. We've been there for many years, but more in the print part. We've done some logistics and some life cycle management. So no, it's an important step for us.
That seems like a good acquisition. If we move on to the margin, you saw margin contraction in the quarter, and then you had plus from the closure of unprofitable businesses, and you had negative volumes. Any other factors that is weighing on the margin?
No, I think more that in Q4 that print had a very good margin, but supply chain, I think it's more about the soft demand. So even if we have done some actions, but lots of these actions will improve margins in 2024. So and we need to know that Q4 for supply chain in last year was extremely good. We have very high margin, high volumes. All operations was running rather well, so it was a tough quarter to compare. So we are actually pretty pleased with the margin in supply chain in Q4 that we managed on that level. Yeah.
And
because still you lose contribution when you lose sales, so you need to compensate on the cost perspective. So yeah.
Mm-hmm. But that's the key, is to get the volumes back, and then margin.
Yeah, absolutely.
On print, online print is growing, but you still saw -9% organic growth in the quarter and 3% for the full year. How big a part is online print at the moment?
I think we made some estimation. I need to look at the full year. I think it should be around 500 million. 500 out of the 2.6.
So about 20%.
Yeah, roughly.
Okay. And I assume then that the growth is quite significant in online print.
Yeah, growth is good, but also you have very good margins in that area, because we are very specialized to run these small volumes, but in an industrial way, and we are not so many who can do that, except the Elanders and some other players. So they are one of the big margin drivers for us. But also we should not forget that we managed to do lots of price increases and also in other print customers that helped us, and also in traditional print after the increased material and energy prices 2022. So, but online print is the big margin driver for us. Yeah. Yes.
Yeah, that was actually my second question, because you expand the margin with more than a percentage point, both in the quarter and the full year. So the main driver of that is online print rather than price increase, etc.
Yeah.
Okay.
But it's still also important for us to continuously consolidate our traditional production, also to keep up the margins in that area. So that is something we are working with all the time, because that has been our reality now for many years. Yeah.
And then finally, maybe you chose to finance the debt of Kammac with debt, and you have a relatively high debt ratios. Explain how you're thinking about the financing of the acquisition.
No, but I think if you have follow the numbers historically, we are pretty good to generate, cash flow and push down on net debt again. And so for us, if we can do it by ourselves and with debt, we think it's better for our owners in long term. Because we feel very confident with that, and I think we showed in our numbers as well. We did like we promised. We released lots of working capital, lower that one, and if we make adjustments for currency and acquisition and so on, we actually pushed down our net debt with 500 million crowns. So of course it will put some pressure on the earnings per share during this year because we will pay a lot of money in interest rates, but over time, it should be beneficial for the earnings per share and for our owners if we can finance acquisition by ourselves and with help of debt. So that was the decision behind it.
Okay.
We also did the Wagon acquisition without, also with the help of debt and ourselves. So yeah.
And also the debt ratio on paper is higher than it would be pro forma because you got the whole balance sheet during the fourth quarter, but just part of the results. Can you say anything about what net debt to EBITDA would be looking like pro forma if you would have owned Kammac for the full year, for the whole year?
Yeah, in Q4 it was 2.84 pro forma
on the rolling 12-month basis,
okay.
And without IFRS 16 effects, excluding IFRS 16 effects on the net debt and EBITDA.
Okay, perfect. Well, with that, thank you very much for coming here to talk to us. Looking forward to follow the story, and soft Q1 is what you're expecting, and that a gradual pickup throughout the year.
Yeah.
Thank you very much.
Thank you.
Thank you, Magnus.
Thanks.